In August 2026, the 30-year U.S. Treasury yield breached the 5.3% mark, reaching a 19-year high. That sharp increase triggered immediate and aggressive sell-offs across long-dated government debt. Because bond prices move inversely to yields, this environment is actively destroying capital value for nominal bondholders, turning long-term government debt into a primary portfolio loser. Macro investors and financial professionals who historically relied on these assets as the bedrock of safety are now forced to reevaluate their entire allocation strategy. The capital protection once offered by long-dated treasuries has evaporated. The underlying variables of fixed income have moved into a higher cost range that many portfolios are not built to survive. Standard market analysis attempts to explain this fixed income volatility as the result of short-term catalysts. Traders point to geopolitical tensions and Brent crude oil pushing past $90 per barrel as the primary drivers. These energy costs keep inflation sticky, which severely limits the Federal Reserve's ability to ease monetary policy. However, research from Amundi suggests these immediate catalysts are masking a permanent structural shift in the global economy. The United States is entering a debt trajectory that exceeds its highest post-World War II peaks, necessitating a permanent increase in government borrowing costs. The bond market is pricing in the mathematical weight of this debt trajectory, creating a pressure that forces a structured fiscal adjustment. To understand this crisis, look at the sovereign debt equation. A government's future debt level, D of n plus 1, is determined by its current debt multiplied by interest cost R divided by the economy's growth rate, G. You then subtract the primary fiscal balance, PS. Throughout the decade following 2008, economic growth consistently outpaced interest rates. Because G remained higher than R, the math favored manageable debt levels. That relationship has now inverted. The interest rate R now sits structurally above the growth rate G. When R exceeds G, tax revenues cannot keep pace with the compounding cost of servicing the existing debt. This mathematical reality dictates that a government must run a continuous primary fiscal surplus just to prevent its debt from spiraling. Applying this law to the United States reveals a severe imbalance. Instead of a surplus, the U.S. maintains a perpetual primary deficit projected between 2.6 and 3.8, 8% of GDP. This chart shows the result. The CBO projects U.S. debt held by the public will climb from roughly 100% of GDP today to over 170% by 204. Many assume the U.S. can outgrow this burden through significant productivity and innovation gains. The projections prove that assumption insufficient. Even with an optimistic 50 basis point increase in total factor productivity, the long-term debt ratio still climbs past 137%. Large perpetual debt deficits combined with these rising debt levels make historically low borrowing costs impossible to maintain. The United States cannot grow its way out of these proportions. The fiscal adjustment is mathematically certain. The bond market reacts to this sovereign debt math by expanding the term premium. Investors are preparing for a significant increase in supply as U.S. debt held by the public is projected to reach $48 trillion by 2034. To lock up capital in this volume of long-term debt, while inflation remains a risk, investors demand a higher yield for the additional uncertainty. This demand for higher compensation is already manifesting in the data. The Treasury recently cleared 25 billion of 30-year bonds at 5.22%, the highest auction rate recorded in over 2 decades. Since Treasury yields serve as the benchmark for the entire financial system, these rates raise borrowing costs for home mortgages and corporate debt across the broader economy. This dynamic also pressures stock valuations. As the yield on government bonds rises, equities must compete with higher returns from relatively safer assets. The term premium acts as a market-enforced tax, systematically lowering the value of long-duration nominal assets because growth alone cannot balance the equation. The government will be forced into fiscal adjustments through spending cuts and revenue increases. Amundi research outlines 2 paths for this adjustment. In scenario A, Y rise steadily, slowly, reducing fiscal space for discretionary programs. Eventually, economic pressure makes spending cuts and tax hikes a political necessity. Scenario B involves an abrupt adjustment. If investors suddenly lose confidence, yields spike violently, causing severe disruptions in global markets. In a high inflation environment where debt confidence is shaken, traditional central bank tools like quantitative easing become far less effective at stabilizing the market. Whether the process is controlled or chaotic, the bond market will ultimately enforce the math of debt sustainability. Translating this macroeconomic shift into portfolio construction requires a fundamental change in asset allocation. Standard safe haven strategies are losing their efficacy because they were designed for an era where growth reliably outpaced borrowing costs. When R is greater than G, money market funds and long duration nominal bonds often fail to protect capital, frequently bleeding real yield. Recent performance data highlights the alternative strategies that are currently providing positive returns. Capital is moving into active multi-strategy debt. Private debt has recorded a 3.9% return year to date, while factoring strategies reached 4%, allowing investors to stay ahead of inflation. Incorporating inflation index structures and private credit provides a structural defense against the expansion of the term premium. In a landscape where interest costs reliably exceed growth, active management and term premium analysis are now the essential requirements for fixed income survival. Chat US debt sustainability and rising Treasury yields 11 sources. August 17, 2026. These sources examine the dramatic surge in U.S. Treasury yields during late 2025 and 2026, noting that the 30-year bond rate hit its highest level since 2007. This upward trend is primarily attributed to persistent inflation, rising energy costs, and concerns regarding extensive government borrowing. Consequently, higher borrowing costs are impacting the broader economy, leading to a significant decline in technology stocks and increased interest rates for home mortgages. While the situation pressures growth oriented sectors and the federal deficit, it offers a potential benefit through improved returns for savers using low risk investment vehicles. Financial analysts emphasize that these market shifts necessitate a rotation in investment strategies to navigate the changing fiscal landscape. Mixed economic indicators, such as rising oil prices and geopolitical tensions, continue to fuel uncertainty about the Federal Reserve's future monetary policy. How do rising Treasury yields impact my mortgage and borrowing? Explain why tech stocks decline when bond yields climb high. Which investment categories are winning and losing in 2026's economy?